Okay, guys, now you should be able to see my desktop there, which just has our disclosure on it. So I'd just like to go through that really, really quickly, that this presentation or webinar is provided solely as a courtesy to aid the education of our customers and prospective customers. It will discuss risk management concepts, strategies, and does not include the recommendation or endorsement of any particular security, chart pattern, or investment strategy by Forex.com. The discussion of a particular market or product herein should not be construed as an offer to sell or a solicitation of an offer to buy in any financial market whatsoever. This webinar has been prepared without regard to the specific investment objectives, financial situation and needs of any particular recipient, and we don't guarantee or verify the accuracy of the information or commentary provided. Futures, options on futures, foreign exchange and other leveraged products, they involve substantial risk of loss and are not suitable for all investors. Spot gold and silver contracts, they're not subject to regulation under the US Commodity Exchange Act. Contracts of difference, or CFDs as they're otherwise known, they are not available for US residents, not because we don't want to offer them, but because of regulatory reasons. Okay, everybody, let's get rid of that and let's get into some interesting bits. Now, just bear with me one moment. Let me clear this. It's all a bit of a mess. As you can probably see, I'm quite in desperate need of cleaning up my desktop. But anyway, let's get going. Right. Thanks everyone for joining. I know that it's a strange week, right? Because it's right in the middle of holiday season. So, it feels like not many people are around. But there's still, the financial markets keep on going and they're very important. Just as a really quick, now this is the Euro sterling actually, which is quite important right now. As you can see, Euro sterling just picked up there, but still not managing to get above that 86 level. One thing we did just get, though, this is a bit of live analysis for you right here, was ZEW from Germany, and it was much stronger than expected. In fact, the current situation rose to 18.3 from 10.6 in July. So even just in 1 month, we've really seen a pickup now, and that is the highest level for well over a year now. So very good German data just out there. UK inflation as well, we had half an hour ago, slightly more mixed. It was, you can see with the pound is slightly higher. Inflation was in line with expectations. The headline annual rate fell to 2.8 from 2.9%. I think the reason why the pound maybe just had that slightly bullish bias on the back of that inflation data, even though it didn't move very much, I have to say, is potentially because it just, inflation is stubborn in the UK, and even though it did edge down a notch, it really just kind of reminds people that it's going to take a long time to come down, to fall. So remember, that's important now. It's going to take a long time to fall now, but obviously inflation very, very important. As after kind of the inflation report last week from the UK. Really gave that as kind of one of the key knockouts, if you like, for forward guidance. So some important data there. That's Ahmed, you're quite funny there, just about how quiet the markets can be in the summer. That is true. But anyway, let's get going, and let's take a quick look actually at euros to start with, because obviously we have just had this data. This is an hourly chart, as you can see here. A couple of things I want you to notice. Number one, we're not really going anywhere. We are trading in a very tight range the last 24 hours. As you can see, this kind of 133.15 level has really capped the upside, and yet we are picking up bids there, kind of around about that 132.80 level. So we really haven't moved very, very much at all in the last 24 hours or since the start of this trading week. Not even that very good German ZEW level. Yes, we pushed higher, but again, that 133.20 level still capping gains for now. Momentum, this is the hourly MACD, so it's very short term, so it can be a bit flighty, a bit capricious. Yeah, it's kind of, it's on the upside, but what I really want to show you is just expanding my time frame. That looks like a double top to me there, 134, key level of resistance. There's a couple of things that you have to remember. Obviously we're in August, and, in August people tend not to be as directional as they can sometimes be, and instead, what we're really seeing is this kind of move or wave of selling interest when we get to that 134 level. That to me looks like it's going to be a double top. looks like it's going to be a very, it looks like a kind of temporary to medium term high. The reason why I say it is that it's significant. It obviously goes all the way back to June as well. We don't really have anything that's going to drive us back above there, I don't think. We have, there's a few things that are just from a fundamental perspective. Obviously, we've got GDP tomorrow, and the market is expecting the Eurozone to exit recession, which is good, of course, very, very good, but pretty much well known now. That is last quarter's data, if you like. And it is well known. It should really be kind of priced in. Yes, we may see a bit of a short-term pickup, but overall, we kind of think that we're just generally done. Like, the market knows the market expects this pickup. It's going to take more than that to get us above this 134 level. For us, that is a really, really important, a really key resistance level there now. And I think you've got to remember as well, we've got a German election coming up, a big export economy that's suffering, the ZEW doesn't suggest it's suffering, but, it's suffered this year, and in a German election, they're not going to want a strong currency. Added to that, we know in the past, you just need to look back here in this February movement, that once we get kind of above the 134, 135 levels, the ECB starts getting a bit nervous, and this double top here is fantastic move, this 137 move here, which really triggered this sell-off, was the ECB, precipitated by the ECB fully. And so for us, we think we have put in top there in euro dollar. We're at 134. Added to that, I just don't see there being, I feel like the focus is maybe shifting, to the US. This week we've got a ton of economic data coming out of the US. I'll go through it with you in a moment. But for me, the focus is not on Europe anymore. And I think when the euro rises, like it did all the way up here, all the way from kind of this time last year up to kind of February, it tends to, the euro tends to be driven by euro-based events. And I feel right now that it's in the Eurozone's interest to keep European things to the back burner. Growth is fine. It's going along quite nicely. I think we're protected on the downside for sure. But I do think the upside could potentially be capped, because as I said, I don't think the Germans are going to want to see. Now, this is all just me. I don't have a kind of a extra special view on any of this, but I do think that we could potentially potentially see some hesitation around that 134 level. But on the downside, obviously, this blue line here, that's a 21-day moving average, that comes in at 132.50. Very, very good support there. As I said, they've really been picking up the bids the minute we get below 133 as well. So we're kind of in a bit of a directionless market. Obviously, for me, it's going to be the US that really, really drives things this week. Now, I want to show you something else as well, because I think this is important actually for everything that we discuss right now. Don't worry, guys. I know that there's been some big movements in dollar yen. I will talk about them in a moment, but this is dollar index I really want to show you, because we are testing a massive level here, which is the 200-day moving average. This is dollar index. Remember, the dollar index is the dollar traded against its major trading partners, like all in the G10 really. And as you can see, it's really picked up. So it had fallen below this 81 level here last week. It had a torrid week last week. It was down against all the G10. Really had a bad, had a bad kind of, 6 weeks, the dollar really. Have we made a bit of a bottom? I think it depends how we react right now. 81.60, that is the yellow line on that chart. That is the 200-day moving average. Pushing us above there could really be a big move, and we could see that really play out, especially in the dollar yen sphere. Potentially also capping gains, as I said, in euro dollar. Capping gains potentially in cable as well, even though cable's a bit of a different story, because cable will be very sensitive to some economic data this week coming out of the UK, which I'll talk about in a moment. So, massive level coming out up in the dollar. For those of you who follow our research, let me just send you a link for our research. I put something out yesterday, which was just how, last week the markets, they sold off, as you can see here. And they completely ignored the fact that, there were some Fed members talking about tapering. The link I've just sent on the chat box, that is the link to our research page, the forex.com research portal, which you can go take a look at. But obviously last week we did see a very, very sharp decline. In the dollar, we saw it sell off very, very sharply. It shrugged off kind of, taper talk, if you like. And I feel like this week, what with the economic data coming back into focus, we could potentially get back, the markets may refocus on the US, and they may refocus on the prospect of tapering from the Federal Reserve. I mean, I wrote a piece yesterday about step taper coming back into view. And we're not 100% sure that they will taper in September. I think it will very much, it's still very much data dependent, as the Fed members are saying. It will depend on some of the data this week. Inflation data, for example, there'll be retail sales. There's Fed speakers as well. So it's going to be dependent on that. It's obviously going to be dependent on August payrolls as well, which come out the first week of September. All of this is important stuff. That we really will need to watch closely. And, for us, that, as we said, that kind of 81.60 level is huge. And if we can get above there in dollar index, then it does suggest maybe some further dollar-based gains. On that note, I just want to show you dollar yen. Just bear with me. I'm just going to pull up the chart myself and then bring it over. This is dollar yen. Nice increase there, as you can see, getting very close. This cluster of daily moving average resistance, prior in the past, it has been support. That comes in around about 98.30 to 70. We're currently trading just below that 98 level. So if we do get above there, we've had a very big move. As you can see here, this is just today's candlestick. The driver of this move higher in dollar yen is broad-based weakness in the yen on the back of the Japanese government coming out and saying that they may cut the corporate tax rate. Remember that, because the yen is considered a safe haven, when they do something that's kind of considered risk on, like cutting a tax rate, for example, that can sometimes can weigh on the yen. So we saw the Nikkei surge, the yen fall. Remember, the Nikkei and the yen also have an inverse relationship. So when the Nikkei rises, it's up 2.5% today. We can see the yen fall. So, for us, that is a great positive move. That should be yen negative, but we would be aware of this resistance zone coming up. And for us, if we're going to get above this resistance zone at kind of 98.30 to 70, back towards 100, because that's really one of the only barriers in the way of that key one, the psychologically important 100 level. If we're to get above there, then we do need to see not just risk on coming from the Japan side of things, but also some good economic data coming from the US, and that's going to be very, very important. On that note, let's just take a quick look at the Ichimoku. That's obviously always important as well. The Ichimoku really flattened out, and that's again a sign that there's, no real trend, no real defining trend. I'd still probably look to that kind of, 98, 70-ish level, which also corresponds with the cluster of moving average resistance there. Up there. Ahmed, any possibility of reaching the 130 target? Probably no. I would say not in the short term. I will just put up a chart. I mean, do you mean 103 or do you mean 130? 130 is a very, very long way away. As you can see here, 130, it was back. You got to look back to the next decade there. Ray, Ray, my Euro Sterling article was written at 4 a.m. And no, that's 4 a.m. US time. So sorry, it's US time that is on there. That is a not so early start for me. That's 9 o'clock. So I wasn't. I'm not that hard done by, but Ahmed, just going back to your point about the 130 target. I mean, I certainly wouldn't target that right now. Remember, we are in summer markets. It can be quite choppy and difficult. I'd probably, the max I'd probably look at is the daily chart in this. I like the daily chart in this because, I'm taking it one step at a time with dollar yen. Obviously, we need to see. We need more clarification on what tapering means to the FX market. We don't quite know that yet because we haven't got it. We also need a bit more clarification from the Federal Reserve about, what does tapering doesn't mean tightening, but it does mean a slowdown in the pace of expansion in the Fed's balance sheet. And one would have thought that would have an FX reaction, but we don't quite know how big that is. It was said before the summer that the new Japanese government was targeting 130. I believe I had something different actually, Ahmed. I heard that they were targeting. That there was some targeting 110. I haven't heard 130. That to me seems very aggressive. I would say kind of, haven't even been back at the kind of 105 level in so many years. I think 130 would be quite a lot. So again, even if, the Japanese government haven't done anything new in recent months to actually get us back to boost the yen. So they're taking it kind of one step at a time. Obviously, there's a big focus on fiscal side of things in Japan as well. So what we could potentially see, what I would see is, I do think getting above that 98.5 level, getting above, and then 98.70, very, very bullish, development. Momentum does seem to be on the upside. That does look like a really nice low there now, around about that kind of 96-ish level, and that could kind of push us higher. As I mentioned as well, we're still not in any defined trend, so I certainly wouldn't be targeting a massive level like that yet. I would certainly, if we can get above 98.70, then I'd look for 100, and then potentially, these highs from early July, round about that kind of 101.70-ish level. Again, we've had false hopes before and not been able to get to that 100 level, so I think people will just be a bit more cautious, and I'd certainly recommend caution. Possibly just, for us, we're still trading in a bit of a range, and there are a couple of positive developments, though. That was a key support level there, that kind of 96 level, which held, which is good news. And then, we do look like we're just still in consolidation pattern, really, until we break out really above that 100 level. So that for us is going to be important. So that nice kind of cone shape there. We've still got a series of higher lows, but we're just not really making any headway on the upside. So we really do need to get above that 100 level for us to be to really even begin to target that kind of 101.70 level, and then that double top all the way back from kind of mid-May here, which came in around about kind of 103, just below 104. Okay, everybody. The other thing, obviously, that's been on a lot of people's minds, as I say, is cable. Cable, massive move last week. Those of you who joined me last week will know, big week for the UK. We obviously had an inflation report, the first one from Mark Carney. They did introduce forward guidance, but if they thought forward guidance was going to weaken the pound, they were wrong. Here we go, bang. It really rose higher, rose very strongly. But interestingly enough, this 155.70 level does look like harsh support. And I mean, we've had a real fail at that 155.30 level, which is the 200-day moving average. I haven't managed to stay above that. That's really capped gains. And that to us just suggests that, there isn't maybe the interest to really get kind of us back to those kind of maybe 158 levels, what even 160 people were talking about. I don't see that demand there right now. Now, we may have to wait. The markets are going to be noticeably cautious. It's obviously a new governor. They need to still try and understand him. We get minutes tomorrow, and we get labour market data tomorrow. Alan, I'll talk to you about Aussie in a minute. We get labour market data, as I said, in the UK, and we get BNB minutes. I wrote something, obviously in that set tape piece, and also in, you can find kind of my pieces on Euro Sterling, my view on the labour market there, on kind of different fundamental scenarios that could be pound positive or pound negative in the next kind of 24 hours in that Euro Sterling piece on our website. So do go and check it. Please do check that out. But my kind of, main view on this is that, when you get the pound, what we need for the pound to really get above this 155.5 level stroke, this 200-day moving average level, right? What is it that we need to get us above there? Well, there's a couple of things. We need the minutes to show maybe, some hesitation around forward guidance. We know that some members didn't really like it. Even though we think they all voted for it, some of them may have been the ones that wanted to water it down. So the commitment to forward guidance may not be that much. Remember, when central banks are wishy-washy in their commitment, that's when the markets can really challenge them. And if there's any sense of wishy-washiness, I'm not saying there will be, but if there is any, then you really need to pounce on the back of sterling, because we think it would move higher. Now, the other thing, of course, is labour market. There is, some in the market, actually labour market is expected to remain fairly steady, claimant count rate steady, unemployment rate stay at 7.8%, job growth in 3 months to June actually expected to pick up relative to 3 months of May. So some positives there for sure. And whether or not we can, if we get better than expected employment data, then obviously that's good news, because the forward guidance has an unemployment rate threshold. So positive labour market data makes rate cuts less likely, which should be currency positive. So again, that could be what jogs us above that 155.30 level. But then obviously, if we get above there, then that 155.70 comes in. Above that, then you're looking at kind of 156.5. So they're the kind of pound positive events. Obviously, weak labour market data could be very, very negative for the pound. It could get us back down to this 153.5 level here, this cluster of moving average support. whereby, overall we could just kind of maybe just trade in a range. But unless we get some better data, coming out with some better labour market data, I'd still see 155.30 being a real top in cable, or 155.70, whichever way you want. Okay, Roy, good morning as well. Let's take a look at Aussie dollar to start with, and then I'll look at Aussie yen. Richard? So this is Aussie. Aussie had a really nice recovery, but it has been stalled. It's stalled at this 92.20 level. In terms of where we go next, you've got to really, you really got to look at this 90.80 level and then 90. This looks to me like a nice bottom here, just below that kind of, 89 level, 88.80. I just want to show you that as well. Sorry, 1 second. This is a daily. I need a monthly. As you can see here, this 88 and 85 to 90 level, 100 months moving average. Paul, you want to talk about gold? I absolutely will talk to you about gold. Hang on. As you can see here, that's held really nicely. So for us, Aussie trading in a bit of a range. We obviously had that rate cut from the RBA last week as we expected, but that managed to coincide with the low. And since then we've moved higher. But we are seeing gains capped. So Aussie to me is not the big mover. Aussie yen slightly more interesting, obviously, because we're getting that move in the yen, that real weakness in the yen. Again, we saw the kind of double bottom here, around about that kind of 80, just above that 86 level, 86.5. The next target, we're currently at 89.40. The next target really is at 90.70. 90 is obviously an important psychological level, but I think in the current environment, if we can continue to see dollar yen move higher, then I think Aussie yen will move higher. So for us, it's not Aussie fundamentals that are driving this move. It's really yen fundamentals. So for that, if you're trading Aussie yen, look at dollar yen. Okay, that's kind of my keeping there, Richard. I hope that helps. Now, Paul, you mentioned gold. Martin, I haven't forgotten you. I will talk about euro in the short term here. So I mentioned last week that I thought this 1309 level would be, potentially a low. We did get below 1280, and that, below 1300, 1280 ended up being a low, and we picked up from there. So again, that for us looks quite important. Now, there's a few things, there's some interesting developments in the gold sphere. The first thing is that we saw a lot of short covering. So actually, the increase in the swing from negative to positive contracts on the CFTC, so that measures kind of futures interest in gold, was its highest ever level. There was like a huge increase in people looking to pick up gold on these dips. So that suggests to me that there's a huge amount of buying interest here. And again, we're just, there's just a nice slow steady uptrend I see. We're getting some nice, higher lows here. And we do know that, below 1300, buyers came in straight away. Now, we don't necessarily know where those buyers are coming from. Sometimes, in September, you can see some extra interest in gold. There's the start of wedding season, for example, in India. Where there's traditionally a lot of gold being bought. People might be buying gold as well because there's a little bit of hesitation around tapering now in the US. If the economic data isn't up to scratch, and we will get a lot more evidence of that this week, then we could see, again, some more upward pressure on gold. Obviously, our next target level, we are getting a bit sticky around that 1350 level. So I do sense a little bit of hesitation in gold, Paul, as we lead up to this economic data coming out of the US this week. As I said, there's like CPI, retail sales today, tons of economic data on Thursday. And obviously if that economic data is weak and does suggest that tapering may be just on the back burner, may not happen in September, or Septaper, as some would like to call it, and then potentially this 1380 level comes into play. Not only was it that 1380 to 90, not only were they the highs from kind of mid-June, so about 2 months ago now, but it also coincides with this 100-day moving average. So, technically that's where we could go. As I said, I hope, you got to look at both the technical factors and the fundamental factors with gold at the moment, because of kind of everything that's been going on. Let's just take a quick look. There isn't really too much else from a technical perspective. Obviously, popped our heads above that cloud at 1334. That's a bullish sign, but we haven't really managed to extend gains on that. So 1330 in the short term, really nice support level. If we can get above here, as I said, that 1380 level would be your first target. With gold, as I said, I don't think the buy case is very strong. I think the recovery case is probably a bit stronger. So for me, 1380 could probably be kind of a take profit zone for sure. certainly for short-term gold traders. But as I said, if we can stay above this 1335 level, the top of the daily cloud in gold, that could be potentially positive. But obviously if we do hesitate and do fall back to there, I think the driver could be stronger US economic data that really makes tapering likely this September. So what about euro dollar in the next 2 days? Martin, as I said, only technical will only tell us some of the way here, because for us the other driver is obviously going to be some economic data. We've seen a little bit of a pickup back above 133 here on the back of that ZEW data. But, Martin, even if we do see a good GDP report and we do see a bit of an increase in gold and we do see an increase in euro or a strengthening of the euro, we think really that 134 level, 134.05 is going to be absolutely slaughter the bulls, because we think that's the big selling zone, a big take profit zone. I think it's this level here. It looks like a nice double top. It's actually not that one. Bear with me one moment. It is a weekly level, and it's this 200-week moving average that comes in at 133.94, really capping the upside. So, Martin, I think that if we were to see a bit of a pickup in euro, I do think it's going to be thwarted at this 134 level, because this is a huge level. A lot of people in the market, a lot of models will know about this 134 level, just below 134, 133.95. It's absolutely, utterly critical. I think that's going to cap the upside. It coincides with that high from June as well. As I said, earlier, I think that, this kind of oscillating between kind of 130 to 134-ish, I think they're happy with. I don't think they're necessarily going to be happy with the kind of a prolonged uptrend. So I'd say that, if anything, it's more of a profit taker, maybe more of something, come in and potentially, fade those rallies that get us towards 134. If we were, for example, to get maybe a slightly stronger than expected GDP. Not many people expect a stronger GDP, but I still think this 133.95 level is going to take a whacker of a GDP report to get above there. And even then, we might start seeing some ECB speakers or whatever else come in, just trying to fade that move. So my bias is actually to fade the move higher. Roy, I did talk about dollar yen earlier, but I will, I'll go back to it. What about dollar yen? I'm assuming what you mean is nearly at 98, as I said, is this 98, 30 to 70 level, massive resistance level. So even if we do get above there, to really keep us going and get us above that 98, 70 level, which is the 100-day moving average, I think we're going to need some good economic data coming out of the US. We've got over the next kind of 48 to 72 hours, some big economic data releases coming out of the US. Retail sales today, then Thursday we've got CPI, we've got initial jobless, we've got industrial data, all of that kind of good stuff. So that's going to be quite important. So if we get to 100, I think if we get above 98, basically, I think whether or not, there could be a bit of hesitation, that 98, 30 to 70 level. It could be quite a sticky level that coincides with this, moving average, resistance. If we are going to get above there and march back towards 100 to the highs from earlier this month, from late July, early this month, then I think we're really going to need to see some good economic data that kind of puts back in focus that tapering aspect. Now, Rafiq, you said Dow and analysis on the stock market. I will look at the Dow. Hang on. Really, they were all kind of moving in the same. The US indices, the main indices are really moving in the same way. I think what's been quite interesting is that the pullback's been fairly shallow. People are still willing to pick it up on the dip. Obviously, there's been some M&A data, a lot of M&A data that's been quite positive. So there's corporate confidence, seems like it's fairly strong out there. Otherwise, you don't get, why would you get so many, why would you get so many, M&A data? And that's limiting the downside for now. But as you can see, actually in stocks, it's interesting because that's not where the volatility is. The volatility is really drained out of stock markets. That's very normal in these markets. It's summer months, but it's also because we've got to these record highs as well. The record highs kind of, 15,658 was the high from the 2nd of this month. So it's no wonder that we've been pulling back. But as I said, a significant pullback, I'm just not 100% sure yet. I think that if we, it'll be interesting to see how the market's brushed off tapering talk, on the back, obviously because the US economy's done quite well. It hasn't really been able to maintain these gains, though. I do feel like that kind of lackluster July payrolls report really weighed on US stock markets and is limiting upside. But likewise, I think the downside is protected. 15,270, that's the 50-day moving average, and then below there, just, the 15,070 mark, just ahead of that 15,000 mark. That is significant. Can it extend gains without a significant pullback? No, I tend to think no, but I think that pullback may take place over a number of weeks. I don't think it's going to be short and sharp. I think it's going to react to, if the focus comes back to the US and tapering. If the markets get freaked out by tapering, then we could easily get back to 15,000, maybe even back to these late June lows here, 14,500. I just don't see it at the moment. I guess you don't believe in Septaper. This is Rocco, and I'm not sure. I think it's open. I don't have a personal view on it, whether or not they should do it. I guess they should start doing it at some point. But I do tend to think that I'm going with what the Fed say. And they said that they're going to wait for the data, for what the data says. And this is an important data week. Obviously, the first week of September is an important data week. When I see that data, then I'll make my decision on Septaper. Someone's asked about Kiwi as well. Take a quick look at Kiwi. It's really been a bit of a wallflower this week. I don't see it as being kind of the key mover. We've failed a little bit here. This kind of 80-70 looks like a nice double top, and we're drifting lower. Really moving in very similar direction to Aussie. Likewise, as the dollar gets its groove back, that's obviously going to weigh on something like the Kiwi, because the Kiwi was one of the strongest performers recently. As you can see, nice move higher, but it does look like that 80-70 level, just below the 81 level, is acting as very good resistance. In the more medium term, over the next few days, I think the 79 should kind of cap the downside, and we could actually trade sideways in Kiwi. I suppose on a more longer term basis, I'm a bit concerned that, this 80-70 level, is a bit of a lower high than where we got to kind of the end of July. So it looks like we're still making a series of lower lows, lower highs, which essentially is a downtrend. And this could just be a consolidation phase. But right now, in the very short term, 79 looks like it's going to protect downside in the next few days, whereas that kind of 80-70 level looks like a very, very good resistance level. But as I said, I'm not too directional on Kiwi at the moment. I feel like it's, I feel like it's just in consolidation mode. I don't get a strong sense it's going to go one way or the other. And I'm not fully convinced of a bullish case for Kiwi right now. With Australia's economic outlook quite weak, with China's economic outlook quite weak, I see it being in everyone's interest, domestically anyway, to keep the Kiwi, fairly range bound. Jer, what do you think about Euro stocks? Will it continue its bullish trend in the short term? I think what's been interesting about European stocks has actually been that there's been a lot of talk about people, a lot of interest in Euro stocks. Obviously, they've made annual gains now, continuing their march higher, even though US stocks have stalled a little bit. I think that's perfectly normal, because there's an expectation that maybe European stocks need to play catch up, if you like. So this kind of high made, the high that we're looking at right now, 2851, very close there, 2839 now. I think we could reach those highs. They're the highs from end of May. And then kind of, where would we go above there? Well, there's, a good few levels that we'd be looking at. This would be kind of, the highest level from 2011. If we get above there, then, 3,000 very much in view. I think the Euro stocks will, whether or not it can continue to drift higher, will depend on a few things. Obviously, continued sense of recovery in the Eurozone. The M&A data or M&A news with European companies being in demand. That's helping things too. And then obviously we need to keep sovereign strains at bay, and they do look like they're at bay at the moment, especially in the lead up to the German elections. Remember, this Friday we get the start of German elections campaigning kicks off. The German election's only a month away then. 22nd of September, something like that. I think that if they, obviously that could kind of has the potential to boost or damage sentiment. Obviously, a win for Merkel would be positive. So do watch out for that quite closely. But overall, European stocks, I still see quite a bullish sign for them. I think there's, as I said, it's more of a grind lower. There's not great liquidity in these markets, but we could get to 3,000 if the economic data does say good. in the absence of kind of a massive sell-off, for example, in US stocks. Now, obviously, if we were to see a sharp decline in US stocks, I don't think the European stocks would be able to move on their own. I just don't foresee that. I think, if anything, they'd also trend lower. So, okay, everybody, I've kept you longer than expected, but thank you so much for joining. It was great to chat to you all. Ray, have a lovely week as well. You're one of the long-termer here. You've been, a very good supporter. Thanks everyone for supporting these webinars. Please do come back next week. It'll be great to hear from you. Enjoy trading this week. Yes, it's summer markets, but there's lots going on. You can really, use this time to digest what's going on in the market, digest the fundamentals, especially since we come back in September, and we go straight into this kind of, Fed focus, and are they going to taper? What does that mean for markets? So, really worth doing this. But Roy, yes, next week, come at 10 o'clock London time. That's the time that we start. So thanks everybody for joining. Good luck this week, and please do join us next week. Thank you.